edition. I'm Brad Gatto, founder and CEO of Fiat Wealth Management, and here with me, as always, is Mr. Tim Holland, the Chief Investment Officer for Townsquare Orion. Tim, as always, thanks for taking time out of your days, which are always busy. I would assume a little bit busier from a timeliness perspective as we record this on August 6th with what the markets are doing. Thanks for being here.
Yeah, no, for sure. It has been a goofy couple, 5-6 days. It's good to see you. As fate would have it, not that we would ever wish for this kind of volatility. I guess the timing sort of worked out early in the month when we normally do these recordings. So that's fortuitous. But it has been
that's nice. If the market's going to have volatility, it's nice that it's going to do it when you and I are scheduled to talk anyway.
You know, I didn't know we were such a big deal. But it's good. It has been a goofy couple of days. For lack of a technical term, but as always, it's good to see you, Brad.
Yeah, you too, sir. Well, let's just jump right in. And so a little bit of a special edition. If you follow along on our monthly market commentary, you know that our normal cadence is a look back, a look forward, and just kind of a good data point that's worth discussing. Due to the volatility in the market over the last week, we're going to punt on that, and we're just going to talk about what everybody's wondering about anyway, which is what in the world is going on? Are we going to be okay? Which is normally what happens when the markets get a little volatile on us. And when I say volatile, I don't mean volatile up, because when it's going up, nobody asks a lot of questions. They just like it. But volatility specifically on the way down. And it's been a minute, Tim, since this has happened, which kind of exacerbates the feeling or emotion around it. So talk to me a little bit about that. How long has it, this run that we've been on? Just kind of give us some context of where we've come from and how we got to where we're at.
Yeah, so short term, in terms of volatility and how we got here over the last 7 trading days, give or take, or 6 trading days, right? We've been in this business for a little bit, and Wall Street investments, I think, is just a fascinating part of the economy. And one of the things that fascinates me is the way investors react to news, right? Because ultimately, markets will be driven by fundamental results at the company level. And at the government level, fiscal policy, and at the Federal Reserve level, monetary policy. And so, as you know, Brad, sometimes good news is good news. Sometimes good news is bad news. Sometimes bad news is good news, and sometimes bad news is bad news. So good news is good news usually when the economy is chugging along, but it's not running too hot, so people aren't worried about inflation and some of the things we dealt with coming out of the pandemic. So that's when good news becomes bad news, when the inflation, when the economy is running too hot and people are worried about inflation, and the Fed's going to have to come in and raise rates and what that might mean for the economy and the markets. Bad news is good news when it means that the economy is slow enough is slowing enough and maybe is weak enough that the Fed can come in and be more supportive, cut interest rates and things like that. Bad news is bad news typically when you're sort of at a point where it looks like the economy is really rolling over and the Fed is too late. And so through most of this year, or at least the last couple of months, bad news was good news because inflation was slowing, the economy was slowing, and investors were thinking, okay, that inflation genie is back in the bottle. The Fed's getting closer to cutting rates. That'll be supportive for stocks, but we're not going into a recession. So we're going to hit this kind of happy Goldilocks construct. And then what happened last week, Thursday and Friday, was bad news became bad news because we got disappointing U.S. labor market data. And all of a sudden, Wall Street got very concerned that the Fed was behind the curve. They should have cut rates at the July meeting, which ended on the 31st. They obviously did not. They don't meet again until mid-September. And all of a sudden, Wall Street went from thinking we're in this nice, slowing, benign economic environment to, oh my gosh, the economy's at real risk of rolling over. The Fed's behind the curve. Corporate profits are at risk. That dinged sentiment, and that obviously dinged equity prices in a very short period of time. To your point, a very volatile pullback. We hit all-time highs back on July 16th, and even back on July 31st, the market was several hundred points higher than where it is today. So that hopefully that makes sense, but that's really what transpired the last couple of days. Bad news went from being good news to bad news and real concerns about the economy.
Long story short, I think, and this doesn't encompass everything that you said, but what I want to point out on all of that is you and I have been a broken record for in these monthly market commentaries for the
Yeah.
last, 10 months plus, just talking about the Fed over and over again and how they're handling
Yeah.
this inflationary environment. And so far, to your point, like it seems to have been working, but I feel like we've been on eggshells. Like everybody's just kind of waiting for the shoe to drop, so to speak. And because we got a couple pieces of data that supported the narrative of, hey, it's possible that the Fed missed the boat here. It's possible
Yep.
that they're going to be too late to the game. And it's possible that the negative sentiment that some people have towards how the Fed is handling things is coming to fruition. And so it wasn't like we've got, months of data or, 18 different things to point to say, hey, yeah, we should have a Black Monday type thing, which some people were expecting on Sunday.
Yeah.
It was literally a jobs report.
Yep.
And kind of a GDP growth data expectation, right?
Yeah. Yeah. So, and to your point, you made a really good comment in terms of sort of markets, sort of how we got here, and then this very sharp pullback. And at one point, the S&P was off about 9.7% peak to trough. So close to that 10% correction sort of hurdle. Before this, we were up, again, only a couple of weeks ago, 18%, 19% year to date, up over 50% from the late 2022 lows, up 30% or so from the late 2023 lows. And really since October of 2023, when bond yields peaked and it seemed like the inflation battle was finally being won, markets have been up and to the right. So I think you put this sort of slow, not even steady, slow, but somewhat parabolic move higher in equities. And you sort of marry that with this concern that presents itself very quickly that the economy maybe is in rougher shape than we thought. And it's you put those two things together, and I think that's going to be additive to volatility. People, as they say on Wall Street, sort of ringing the register, taking profits, because we have had a wonderful 9-10 months, which is great, but nothing goes straight up. And the upside to a bit of a pullback, as unpleasant as the last couple of days have been, if you don't think the economy is really at risk, and we don't think it is, you reset valuation, stocks become a little more attractively priced, and maybe more importantly, you reset sentiment, because I think people were maybe getting a little too giddy about equities just because things had been so good for 9, 10 months. And so I think putting all that together was one of the reasons why I think maybe markets pulled back as quickly as they did.
That never happens, Tim. People don't ever get too giddy about the markets and kind of forget the fact that this is not a straight line.
That's good to know. Okay, I feel
which
better.
is, of course, a heavy dose of sarcasm, and myself included. I mean, everybody's guilty of it, right? Because it's an emotional ride. Anytime you've got money that's at risk and can go backwards, it's always in the back of your head a little bit, and we get a little sensitive to it. So, with that being said, what I want to talk about now is 3 reasons why people should remain positive, or at least give them glimmers of hope relative to this recent volatility that we've had. And point number 1, I want to call people still want our debt, which can be perceived as bad, I guess, because debt isn't necessarily a positive word. But tell us why that matters and tell us why it's positive.
Yeah, no, it's a great point. So the U.S. 10-year note is arguably the most important piece of financial paper in the world, right? The government finances its day-to-day operations through tax receipts, but also by issuing a ton of debt. Those are bills, notes, and bonds. Notes are sort of in the intermediary part of the curve in terms of duration or how long they're sort of traded for. And so the U.S. 10-year note is also the yield on that note is the yield or the interest rate that banks think about and credit card companies think about when they're setting mortgage rates and credit card rates and things like that. So it's super important, not just here at home, but around the world. It's the world's most important. It's a risk-free piece of paper because the U.S. hasn't defaulted, won't default. In theory, doesn't need to ever default. And so as markets got very volatile the last couple of days, what you saw was the U.S. 10-year note yield go down dramatically because people were buying a bond or a note, and it goes up in value, the yield comes down, right? There's an inverse relationship. And to me, that's a big deal from a macro perspective, because with all the problems we have, and we've got a few for sure, during periods of global market distress, international and large domestic investors want to buy, to your point, our debt. That speaks to the fact that we remain the world's most important nation, the most important economy, and the U.S. 10-year note remains a safe haven asset. And that's a positive that trumps any sort of near-term volatility. Just speaks to this advantageous position our country is in and continues to be in. So for me, that's a huge, huge macro positive, if that makes sense.
Yeah, it does. At the end of the day, while we have volatility in our equity markets, the safety that people are seeking is our economy, just generally speaking, right? If you didn't believe in the long-term viability of our economy or in our free market system, whatever you want to call it, you wouldn't be buying our debt. This is not where you'd go to be parking your money. And so when the safety play is still our debt, that means that a lot of people see positivity long-term inside of this short-term volatility. So great point. Point number, go ahead.
No, I was going to say, well said. I think that's you hit the nail on the head.
Point number two, just it's possible we're wrong. It's always possible we're wrong. Oh, I lost your video feed. Still there?
Yeah, I don't know. Can you hear me?
I can hear you.
Yeah. Okay. Let's see. Bear with me.
I think the listeners, that they're all good, but from a video perspective, it'd be better if my video dropped. Yours. While you're working on that, so point number two, again, we could be wrong, Tim, but on the surface, don't see any monster in the closet right now. And so talk to us a little bit about that and what that means.
Yep. No, and I apologize for the video conking out on me. I'll noodle around with it. So
no worries.
So the economy is softening. The labor market is softening. We've talked about this. We thought it would happen because the Fed took rates to 5.5%. And when money becomes more expensive, people spend a little less and they invest a little less. So that's not really all that surprising. So then the question becomes, well, are we in the cusp of something much more meaningful, akin to 08, 09, or the early 2000s? And typically, you only get that kind of downturn in the economy is if there's something really structurally amiss, right? Housing in the late 2000s, the tech bubble 25 years ago. And so recently, the Federal Reserve conducted its annual stress test of the 31 largest banks. They have to do this. They've done this since the Great Recession. When they look at these 31 banks, they put them through this test and they assume some pretty dire economic conditions. Unemployment goes to 10%. It's at 4.3 now. Real estate prices fall 40%. And the stock market sells off like 25-30%. And then they ask themselves, do these banks need more capital, or are they financially viable? And all 31 banks passed this very onerous stress test. So we don't think there's something under the surface that would lead what we think will be a mild recession or a soft landing to turn into something more sinister. And we think that is, again, a huge positive as we navigate this near-term volatility.
Yeah. So important to note in that, we're not saying is, one, the last handful of days in the market didn't happen. We're also not saying it can't go down further. The point being simply that, look, it seems as though there's a bit of a safety net down there, given the fact that in spite of the stress test that you're talking about, where, the market's being off very significantly, real estate being down significantly, and cash becoming a problem for these banks, all of them are passing the test, it doesn't look like, at least from the perspective of some of the financials, point number one, people buying our debt. Point number two, the largest financial, banking institutions in this country, all passing a stress test. It looks like it's going to be a softer landing for us, to the point where we're not going to see a 50% pullback like we did in 08, 09. Yeah,
no, exactly. And again, I apologize for the video. The banking system seems to be in very fine financial shape. And the banking system is a transfer mechanism for sort of Wall Street and the real economy. And if banks have to pull in, if they don't have access to capital, if they don't have credit to extend to consumers and corporations, the whole thing seizes up. And that's what happened in 08 and 09 when all those mortgages started to go bad. So I think the Fed, its credit, what they have done with the banking system the last 15 years or so, and even how they handled the regional banking crisis of March of 2023, I think speaks to the fact that regulators don't seem to be asleep at the switch. The system's well capitalized. And to your point, that's one less thing we have to worry about. And it's a meaningful thing that we don't have to worry about, if that makes sense.
Yeah. Yep. Perfect. Well, point number three, and the last point for this update anyway is, and for me personally, I think this is the most important point. Doesn't mean that it is. Again, this is just my opinion. And what I'm calling this point is that we're stocked and ready. And
Yep.
really what I'm talking about there is the interest rate environment that we have. And so, Tim, can you shed a little light on that?
Yeah. So one of the upsides of the Fed taking rates to 5.5% is that the Fed took rates to 5.5%, right?
Yeah.
So if you go back to pre-pandemic, post-Great Recession, and we've been in this business for a while, the Fed kept rates somewhere around 1.5% to 2% for a very long time. There were concerns the Fed could never raise rates. We would never get any inflation. And I know we've had too much inflation for sure, so I'm not discounting that. But I think the fact that the Fed has taken rates to 5.5%, to your point, the monetary policy construct, the room they have to cut rates is significant. So if you're
Yeah.
at 5.5% and inflation is running at 3%, give or take year on year, the Fed could cut over 200 basis points or more than 2% lower borrowing costs for consumers and companies, and you would still have a reasonable level of at the Fed funds rate relative to inflation. So we do have a lot of proverbial ammunition to after slowing the economy to get the economy going again by meaningfully lowering borrowing costs.
And I think it's so important because at the end of the day, it's a scary proposition to purposely slow down your economy,
Yeah.
right? And there's been other major, first world countries. I think of Japan. We talked about this a little bit ahead of time, that it becomes a problem when
Yeah.
you get down to the point where you have no kind of dry powder left and you're not stocked and ready, like we are right now with the interest rate environment being what it is. Once you slow down the economy and you get rid of all of your dry powder, how do you get back to the point where you have the ability, your economy is strong enough that you can put a headwind in front of it purposefully,
Yeah.
and it can still continue to move forward.
Yeah.
And we've been able to do that. And in spite of doing that, I mean, look what the markets have done while the Fed was busy trying to slow things down.
Yeah.
And so it gives them some wiggle room if things start to go sideways here more significantly than we're thinking they might, predicting they might with some of these previous points of the fact that people are still buying our debt. Doesn't seem
Yeah.
like there's a big monster in the closet right now.
Yeah.
We've got a lot of room to move, which is
No, for sure. No, I agree. And so the Fed meets again mid-September, right? There's a lot of talk that they might cut rates before then. They have done that before, but they've tended to only do that or have only done that during periods of real economic distress. So if we're not there, they won't. The one other thing everyone who's watching this video to maybe keep an eye on is every year the Fed goes to Jackson Hole, Wyoming, pretty cool ski town, August 22nd to the 24th for a big sort of global central bank conference. They invite folks in from the ECB and Bank of Japan. So a lot of folks on Wall Street will be paying attention to that event because Chairman Powell and his colleagues will be talking monetary policy, and lots of folks will be, a lot of media will be there given the volatility of markets last couple of days. So just a date to keep in mind a couple weeks out.
good to note. The last point I want to make to what you said, which is September 18th is the next Fed meeting. So we've got ways before that happens. Some people think that that's a negative because they think they need to react sooner. It's just good for everybody to know that they can. Just because the next meeting isn't until September 18th doesn't mean that they can't get together and make the decision to lower rates. That being said, if they don't, that should give you, again, that should be an optimistic or a positive sign to you that they don't think it's worth kind of stepping in between their regularly scheduled meetings to make kind of some sort of emergency declaration of a rate decline. So It'll be interesting to see here what happens over the next handful of weeks. But I just want to kind of wrap up by saying this. Number one, we're watching this stuff. We have a whole team that watches this stuff. We're all over it. And so if you're a client of Fiat, I just want you to know that this is that we're on it, number one. Number two, if you're a client of our firm, we expect this stuff to happen. We expect the markets to go up, but we also expect them to go down. Our view has not changed. We think that the long-term prognosis of our markets are positive. We believe in the free market capitalist system, which is why we're in the markets to begin with. And there's not one client here at Fiat where events like this, volatility like this is not built into your plan. And so if you don't see your advisor calling you or somebody at Fiat calling you to make significant changes, it's not because we're not, we're sitting on our hands not doing anything. It's because this was baked in. The assumption that this is going to happen is baked into the plan. And I would argue that a good financial plan in moments like this shouldn't have to run to safety. If anything, it's in moments like this that you seek opportunity. And so an extreme example of that, a recent example of that would be COVID. So for the families that were with us during, the March of 2020, when the market, of course, precipitously fell, in a month's time, it was down over 30%. We were using that as an opportunity, and we were making moves in the equity markets, making moves from a tax perspective to take advantage of the volatility of the market. So if anything, we will try to find the opportunities in these market movements as we always do. So stay tuned, because if you hear from us, it's going to be more on that side of the coin than it is us running for the hills, because we've got plans in place for the market to do exactly what it's doing right now. So if you have any questions, though, we're always here. Again, if you're a client of the firm, we're on retainer to you. We're here to serve you. So feel free to reach out to us at any point in time. Happy to answer any questions, have any conversations that you want to have. And Tim, I greatly appreciate not only the time that you give us every single month to have these conversations, but on top of it, that you and your team are staying on top of this stuff, and the time and energy that you put in just over the last handful of days to make sure that we've got really good feedback on what's going on in the markets, so that we can get that information to our clients. It's invaluable. I appreciate it.
No, I appreciate that. Appreciate the kind words. Just like you and your team, this is what we do, and it's sort of all we do, and we love doing it. Now, if I could just figure out how to make my video work again, I'd be batting not 1,000, but the average would go up. So I apologize for that. If things get bumpy, happy to hop on between now and early September, obviously. But look, it's always good to see you. It's always good to connect with you, Brad. Look forward to talking again next month. And if there's anything we can do for you and your team and your clients, just let us know.
You're going to visit a very wine and wisdom event. And so if you've never been to one of those events, I will also plug that. They're an opportunity for you to bring friends or family or people that you care about, and learn a little bit about wine and get a little bit of financial wisdom. Normally, unfortunately, you have to listen to me during those events, but not in the month of August. Not only were you leaving the office and going on location to a winery to get this done, but Tim's going to fly in from Pennsylvania and join us and talk about a little bit of financial wisdom as well. So put that in your calendars, the Wine and Wisdom event in August. All the information's on our website, fiatwm.com. Thanks for joining us for this month's monthly market commentary. We will see you in September. I almost said August. This is the August monthly market commentary. See you guys in September.
Take care.